Anyways, S&P 500 is ripping here. Ripperooski up 2.87%. That's the SPX, but take a look at the SPY, up a whopping 3.3% in the pre-market. Markets are absolutely ripping. Now, I'm going to be obnoxious if you're a bear, and I apologize, but if you're a fellow bull, then this is really what we've been looking for. I think we might actually have signs here of a bottom. Now, I have to be careful with that because I said that over here and I was wrong. So let me back up my opinion on why I think that we may have just seen the bottom for the bulls. And if you're in this with me, this is why we don't try to time bottoms on a long-term perspective. Okay. We had news this morning that China wants to talk. Okay. And this is the biggest opponent. This is the final boss. So if China wants to talk, according to Trump, if China is like, let's negotiate, let's discuss all this stuff, you know what that means? That means the big boss, the big op, the big antagonist in this story. I mean, I guess maybe you could say, depending on who you ask, maybe Trump's the antagonist, maybe China's the antagonist. I don't know. But one side of the aisle saying, let's negotiate. Trump, of course, took to social media immediately in typical Trump fashion, saying they want a deal. They want to make a deal, right? So that happened this morning. Markets up, ripping your face off rally. This is why, ladies and gentlemen, I do not like to short the indices, and why I have been screaming, pounding the table. I've been Donkey Kong over here. You don't chase sell-offs for this exact reason. The put to call ratio could be yet again signaling the bears are going to get crushed. Okay? Let me show you why. I cannot tell you how many people in my comment section in the last few weeks have been saying, Nick, it's not too late. You should just be short. You should just be bearish. And I guess short term, to their credit, they were correct, right? And this is not necessarily over. So don't get me. I'm not getting ahead of myself. I'm not all in leveraged long. So just understand, this market has been going down, and in the last like 48 hours, the bears got so loud. This weekend, my Sunday video and my Monday video, people are just outright howling bears, right? They're just, what do bears do? What the bears, they don't howl. They roar? What do bears roar? They've been super loud. And the reason I say this is because that's typically what happens at the bottoms. People get obnoxiously loud about being bearish. This looks like, again, it's too early to call this, but it looks like a capitulation bottom. That's the type of candle you get at a bottom. What do I mean by that? Well, typically when markets are bottoming out, everybody gets bearish at the worst possible time. Check, everybody's bearish, right? Put to call tell you everybody's bearish. Even if you're not necessarily bearish yourself, what I'm saying is that the consensus is extremely negative out there. So if everybody's saying, oh, I'm cautious, or I'm bearish, or I'm short, or I sold my stocks, that typically happens at the end. That does not happen at the beginning. People are not smart, unfortunately, in markets. They do what the crowd does. People were all in long here, and now everybody's sold their shares, sold their positions, and bought puts. We launched the Edge Finder 3 years ago in April of 2022. And now, years later, the tool has helped thousands of traders take their fundamental analysis and sentiment analysis to the next level. Traders can track things like the commitment of traders data, which shows institutional money flow, whether they're buying or selling certain assets like gold and currencies and indices. Additionally, we've made economic heat maps that allow traders to track easily the fundamental or economic data trends that we're seeing in markets right now. You can also track retail positioning and see what the market sentiment on your favorite assets are right now to look for some contrarian signals. And of course, it strings it all together with the top setups algorithm, showing traders the most convicted top ideas that the Edge Finder is producing now. The Edge Finder has helped traders go from beginner to pro in terms of the fundamentals, and has helped many traders go from unprofitable to finding the missing pieces in the name Edge Finder. So if you're not already using the Edge Finder, let me tell you about the biggest discount that we offer all year long long starting right now. The 3-year anniversary sale is going to be our biggest discount that we offer all year long, and it is now available to people who are watching right at this moment. Traders looking to get access to the Edge Finder can take advantage of this massive discount for a limited time using the link in the chat being dropped right now or in the description of this live stream. If you've been thinking about getting a copy of the Edge Finder, do not miss this opportunity. It is the lowest price that we do all year long, and it's a one-time payment to get access to the tool. So don't miss it. Celebrate 3 years with us by getting yourself a copy of the Edge Finder at the super discounted prices. Thanks for watching. And now back to the show. Now, I'm not teasing people who have done this. I'm telling you what has consistently for as long as I've been watching the markets, what has happened. At the end of bear market moves, right? Or at least short-term bottoms, what happens? People get incredibly loud, okay? So, look, could this be a fake move and we go lower? It could. But what I'm telling you right now is that shorting in these candles is not only difficult, but it's outright, in my opinion, it's outright dumb. I'll tell you why. This is my opinion. All of this is, of course, my opinion. I could be wrong. Markets could go lower. You know the drill. But when everybody's bearish, the cost to buy bearish bets goes up astronomically, goes up massively. If you wanted to buy puts the last few days, you paid an arm and a leg to buy puts. What do I mean by that? Well, puts are bearish bets, and to buy them, you have to pay a premium. That premium has gone up tremendously. So if you wanted to bet that this market's going to go lower, okay, let's say you bet it's going to go down here, right? Well, in spread, aka the premium, you might have paid this much in premium. So if the market goes anywhere above this area, you lose money. That's what puts are not telling you about. This is what happens every time we hit a market bottom. This time is not different. I will be obnoxious about that. People are saying this time is different. That is an indicator that it's not different. Okay? When everybody's saying this is the end of times and this time is different, Fed's not going to save the day. Trump's not going to save the day, right? When you have everybody saying this time it's going to crash. I will take 99.9% of the time. That's a good chance that you're getting closer to a low than you are to the highs. So yesterday I bought a lot of stocks. I bought a lot of stocks yesterday. I also bought gold yesterday. Nice bounce back on gold. But I just want to caution you. Let's say you disagree with me. Let's say you're watching and you're like, no, Nick, you are wrong. This market is going to go lower. Fine. I'm not saying I know for sure what's going to happen. But let me just hope that if you are a bear, you are being constructive and not chasing. So if you are a bear, right, then you know what I'm about to say. If you're a bear and you're being constructive and you're being patient, Chris Pulver and I had a conversation like this yesterday. He kind of leans more bearish recently. You know what Chris said? He said, let's wait for something like this. Get the bulls out of the way, and then bears could take it over again. But again, I'm speaking right now about the people who absolutely took huge bets. Do you guys know there was a liquid options exchange happening for 20% down on the options chain yesterday for SPY? If you know what that means, you know what it means. People were making bets yesterday that the market would drop 20% in a day. I've never seen bearishness like that. Never. I've never seen it in my career. I've never seen people be so outright negative about the markets in my life. And I've been doing this for a long time. I saw 2020. This seems like more bearishness than 2020. And what happens? What happens next? Again, I'm not saying that this is the low and that we're going higher back to the highs from here. That's not what I'm saying. But understand that sentiment that we had yesterday, even if you are a bear, I think it's reasonable to acknowledge, yeah, everyone got bared up. Everyone got bared up. And in typical fashion, what does the market do next? It kills that chasing mentality, right? Everybody thought, yes, Lincoln, you're right. Literally, people were saying, It's going to be Black Monday, and positioning as such. People were outright, like I said, so if you don't know what I meant by like there was an exchange or there was contracts trading 20% down in the S&P on the options chain, right? For the S&P 500, I'll just show you really quick. So if I go SPY and I go options, people were trading 0 DTE options 20% below current price. Like 0 DTE options 20% in a day. That's never happened before since 1987. One time did the market go down that much in a day. So my point is, we have not seen that kind of like bearishness, people making massive speculations that the market was going to crash. And what did the market do? It closed positive yesterday. What's it doing today? It's ripping higher. So like I said, the market could go lower. I'm not saying, oh, this is over, it's done, it's all good from here. That's not what I'm saying. I'm saying sentiment matters. This is why traders pay attention to sentiment that know what they're doing, right? We look at these indicators and we say, oh, even if you're bearish, careful, right? You are chasing like no other chasing if you're bearish right now. I'm sorry, let me rephrase that. I'm not trying to disrespect people who are bearish, right? If you are bearish and you have a good reason, great, no problem. What I'm saying is if you are super leveraged short and you are ignoring what I'm showing you here, I'm just saying be careful, because this is quintessentially what people do at bottoms, okay? We have moved since everybody called for a Black Monday. We're up 9% in 2 days. Remember that when the market's crashing, right, it can move down lower. But you know what's just as strong in bear markets? Bear market rallies. Okay? Bear market rallies. So even if you're bearish, this is why we don't get bearish at the worst possible time. This is why if you are bearish, you wait for the bulls to have a turn. And then if you're still bearish, then you can do your shorting and you can look for those opportunities. You do your thing. I'm not here to tell you what to do. I personally won't be shorting this market. I'm going to continue to add stocks, and I hope it goes lower. I hope it goes lower because I want to continue to buy stocks. I think this is a long-term generational opportunity to buy stocks low. That's my personal opinion. I could be way early. I don't really care. For the long term, I really don't care. In fact, for the long term, I hope this thing tanks another 20%. Because then I could really get some stocks at great prices. US stock market just opened up, and there it goes. We'll see some volatility pick up here in the 9:30 trading hour. Should I buy Tesla, lads? I mean, Tesla is your ultimate proxy, right? I am very long Tesla, but understand Tesla is very, very high risk, high reward. So let me also disclaim something. If you're feeling, oh my gosh, I missed it. Oh my gosh, the market's bottoming. Relax. This market is so volatile. We could be down 2% by the end of the day. We could be up 6%. But this market is right now, I'll tell you what it's doing. It is rewarding people who are stepping in, who have been waiting cash heavy for a long time. Here's my opinion on this. And all of this is opinions. Like, people are disagreeing with me left, right, and center on my videos. That's fine. I don't care, right? But I'm going to give you guys my takes on this stuff. I think this is a long-term opportunity for people who missed. I'm not talking about, you know what's happening right now? Rich people that own stocks, specifically hedge funds, many of them are in the process of aggressively deleveraging. Okay, what does that mean? Market's been going up. Hedge funds, just like retail traders, get caught up in leverage. They're like, oh, everything's so good for markets. I'm going to make a ton of money for my clients. We're going to go take a loan out with the bank, and we're going to go long NASDAQ. Well, right now we've seen an interesting sell-off move, which is, in my opinion, massively rewarding the patient investors and managers in this market that did not get greedy and chase. Market has a funny way of doing that. What's happening is a lot of investors, a lot of hedge funds, in my opinion, right now are deleveraging. They had huge bank loans and they needed to cover their positioning and get out of the way. And so we saw massive sliding selling, right, in record time. And this big selling may have led to, some margin calls or some straight up margin calls on the hedge fund level, which can cause more selling. Is this all over? We'll see. From a trading perspective, what I'm looking for this week would be CPI and PPI to come in soft. What I mean by that is cool. We want low numbers, okay? Low numbers gives the Fed the opportunity to cut rates. Fed cutting rates could potentially be, yet again, what saves the day to this market. That's what's happened the last 10, 15 years. The market goes down a ton, Fed can step in and cut rates. These figures are important this week for that very reason. If you're going to get the Fed put, quote unquote, that saves the day, we need inflation that is not problematic. Okay. What do you think about gold? I'm long gold. I picked it up yesterday, got it at the 61.8 and reversed almost immediately. I'm looking for an opportunity to trail stops on this one. I think gold has more upside. I'll tell you what, here's one of the reasons I like gold personally in this environment. You're having a big short squeeze day today and people rushing back into stocks. I also think it's very worth, in my opinion, watching gold. Here's why I like gold. I think gold offers a middle ground for people who are like, okay, we might be, things might not be, tanking and cratering, but I don't think this is necessarily over. Well, that's been part of the reason gold's been attractive. I think it will continue to be a reason why gold is attractive. I also think that central bank buying is going to continue to ramp up for gold because clearly the US and China relations are like this right now. China's a big gold buyer. And I think as they potentially deleverage from US denominated stuff like US treasuries, they may accumulate more positioning in things like gold. So I like gold quite a bit to the long side. I am long currently. I have a good sized position on this one. I'm also quite heavily long US stocks at this time. I really went shopping in the last 2 weeks. I by no means caught the bottom, but I've been accumulating this leg lower. I've been very much building into stock positions that I like for the long term.
Pretty wild swings yesterday. Just to put it in perspective, we had a percentage move intraday from a close Friday, a gap down of about 4.5%. So we gapped lower about 3%, pushed another 1.6%. So we had from close Friday to low Monday, 4.62%. That was kind of the extent of what this near-term pain has felt like. Then we had a rally of 8.55% intraday that then ended up settling right back into the middle, and it basically finished completely flat. Crazy kind of shakeout type day. IV was incredibly high. I took some more bites and nibbles. I added some trades into the pulver alerts. Those trades include a trade. Excuse me 1 second. Let me go down to my tracker here. So includes a trade on IWM, Micron, Apple, Nvidia, Google, SPY, Delta Airlines. TLT I'm a little kind of annoyed with. I didn't do anything other than roll my calls out, and I tried to roll them up. I still think TLT looks fairly bullish towards the 100 handle. But in this near-term equity rally, it's not a surprise we're seeing a dip in bonds and a rally in equities, just as a little relief rally. And I also have some puts, SPY and Qs. This was for my margin accounts. I did some naked puts, 435 put on the SPY and a 365 put on the Qs. Right now, each one of those are up around 50% within a week. So that was the nice thing about selling premium. It looks like this. I'll go back to SPX in just a second here, but here's the VIX. VIX was all the way up towards 60 yesterday. That was the high of the day. And then we just aggressively faded off of that. So VIX, naturally a reverting instrument. I wasn't, sure. Obviously, nobody was when the VIX was going to stop. This was the third largest spike at all time. I think this is the third largest. I can confirm that here, but give me 1 sec. Let's go. Pretty sure this is at least top 5 VIX, but we're talking crazy crisis levels that we've seen in the past. But there's always something else. There's always some other extreme in the market. You never know. Okay, so we are officially now the worst performance through the first 65 trading days. It is 5th all-time worst for the first 65 trading days of the year. Congratulations. If you can survive 2025, you just survived the fifth worst start in the first 65 days of trading. What else do we have here? Roughs, recessions. Oh yeah. I talked about this yesterday in class. Biggest 3-day spikes. There you go. So the biggest 3-day VIX spikes since 1990. It is 5th and 6th all time. Biggest spikes in the VIX. Impressive. One indicator that I've been mentioning for the last couple of months would be looking at your S&P above the 50-day moving average. Right here, I've taken some nibbles. That's all it is. I don't think the lows are in necessarily. I think there's still some more pain and uncertainty ahead, but a relief rally certainly feels pretty good for maybe the next couple of weeks. I think this little cycle between like March expiration and April expiration might offer a bit of a kind of corrective window. So we had like all of the interim like tariff tantrum pain priced in. That's what yesterday's wild price action was. But this to me offers up a little bit of a bargain. If you wanted to go short-term long the S&P, it's a pretty good time to do it. The last time it was this low would have been the bottom in 2023 after that August-September pullback to around 8 to 10%. And before that would have been the summer and fall bottom, which was the bottom. This September bottom in 2022 was the bottom of the market. So before that, bottom in 2020, that's a COVID bottom. Bottom before that would have been Volmageddon in the end of 2018 when the Fed raised that fourth time. The market crashed in December 2018. The Fed kicked right back in after a 20% correction, and another good time to be buying stocks. And we melted up to all-time highs all over again. So you don't see this very often. This is why I angled my portfolio short-term long, and seeing the benefits of that today. So I've got some trades in on SPY, QQQ, some naked puts, like I said, selling some high premium. I'm not necessarily looking to hold those all the way to expiration. Some of those expirations are out into May, out into June. But if I'm at 50, 60, 70% profit on those trades, I don't need to worry about the gamma risk towards the expiration of those options. I'm just going to take a majority of the profit, move on, and get the buying power back. So let me have a quick look. Up on the day, I mean, obviously P&L's had a huge swing. Right now we're, sharing, you show me mine, I'll show you yours. And, my portfolio is still red for the year, but certainly doing a lot better. So 67K-ish floating out of the total to the start. So I'm down 2.3% for the year, but I'm still sitting on, hedge profits and positions that just need time to work. Position levels that aren't necessarily threatened. It's just been a big change in volatility, and that has made option prices go wild and crazy. So Tesla back up above 248. It shows here that I'm down 26K on Tesla, when the reality is if we stay above 247.50, I'm going to make like $8,000 on Tesla this week. So it's just option prices have to settle down. If we can stay above 247.50, I'm not going to get cute with this. I'm just going to let it get called away. I'm not going to roll it. I'll take the income trade. I sold some premium on Tesla. I still have some ratio spreads running with out into May, so those aren't threatened just quite yet. Let's go to those naked puts for a second. So here is a put on the Qs. I think I did a put on the Dow as well. Let me double check that. So Dow, I did a 1111 trade, so that's a 360 on the Dow. That's currently down about $900, but that trade, we'd have to see the Dow drop another 10% for my position to be in jeopardy, and that trade is good for a $550 winner. So is that what I did here? Buy. So I did a 112. Okay, so I'm selling. That's why. But this is only out to June. I'll keep a close eye on this. But we'd have to drop another, we'd have to drop basically 10% on the Dow in order for this trade to be threatened. Not that it can't, but I still collected some pretty high premium with some of these recent moves to the downside. Let's go Qs. So I have a put that is up around $100 right now. A trade right here that is already up $126 just in the last 24 hours. So this trade's up 22% real quick. I'm going after like a 30 to 40% winner in this one. Keep an eye on those. And then SPY, my put, this is just a naked put. Is that one grouped? Hang on a second. SMH, that one's looking fine. This one is ungrouped. So this group, there we go, naked put. Okay, so this is, there we go. So it's getting these labeled. So looking at profit there, naked put for 435, already up some bucks. Naked put for 460. This one's taking on a little bit of heat, but I'm okay with it right now. I collected 423, and you know, this is an example. Like I collected $4 and change on a 460 put. We're trading at 524. You know, I'm 60 points clear of this. What was the low on the SPY? I don't think the low was, you know, 460. The low was around 480, right? So we'd have to revisit this low by, I guess, June, which is possible. But I'm also not, I'm not opposed to taking ownership and shares of the SPY with this account, which has $250,000. If I bought 100 shares at 460, I can allocate that and take a chunk of shares and repair it. So anyway, point is, a lot of trading going on. You know, this will be a living, breathing P&L cycle. My goal is to get back to the yearly highs, which my yearly highs were around 205K. And that was after the March decline. So we had the March decline, had that little 2-week rally. I was at 205K right there. So now that we are dramatically lower than that, you know, I'm hoping for a little relief rally. I'm curious to see how close I can get back to those all-time highs again and still be better positioned for, you know, all-time highs, no problem. You know, if we get back to all-time highs. However, I don't think that this market is just done going down. Earnings season is kicking off on Friday. It starts with the banks. So this is what the earnings calendar looks like. It's not super busy. I mean, we only have, I'd say 20, 30 notable names this week. But Delta, which has had a monster decline of about 50% since the all-time highs. And then we start out with Friday, what's going to be kind of the big guidance for Q1. JP Morgan, BlackRock, Wells Fargo, BNY, Morgan Stanley, their guidance / comments will be interesting. If they, you know, just talk, hey, these are the numbers, earnings per shares, revenue, our consumer. I mean, I don't know. I have a feeling they're maybe going to say something tariff related, maybe talk about the current environment and uncertainty. But if they wanted to do kind of a solid for the overall market, then they should probably keep it pretty neutral, if not somewhat optimistic, if they even are. You know, look, I think that what the banks went through in 2008, that they are more battle tested and prepared to prevent a 2008 from happening again. Not saying that it can't in some different way. But point is, I mean, it kind of sucks to have to report earnings right now, right? After dealing with a what is almost like a systemic risk to the markets, but you see the intercorrelation, you see the connectedness, and you see the volatility, and you see how quickly the market can just go into like straight fear mode. It is irrational. I mean, you can't think your way like, oh, that made sense. I mean, the only thing that made sense this year to me, and again, this is all from a technical standpoint, is we had a correction in the 200 moving average and we paused there, and all this was a measurement. It's not that difficult to measure this move. Watch. So if you go from high to low, okay, and you measure this move to the downside, that's pretty darn good. I will do that again if you missed it. It's kind of like a magic trick. But a cup and handle pattern, which is the market drops aggressively, pauses. The way you measure that move is you box this high to low in, and then you measure that breakout move. Okay? And watch how pretty perfect that box is. Here is the high to low swing right here. Okay? And then watch the breakout point. I'm just going to copy and paste this. Boom. Copy and paste. Put it right at the breakout point, and look at where the market bottomed. Right there. That is why at the, 490, 485, 480 level, I was looking out of the money, high implied volatility, selling puts. right? Doing bull put spreads. I mean, they're out of the money, but I was getting, $4, $5, $6, $7 on some of those puts for a probability that IV is not going to continue to get higher, and you could go way outside of the expected range for what is lining up to be a pretty safe trade over like a 45 to 60 day window. So the market from a technical standpoint did pretty darn well, despite how nasty it felt. It was destination technicals. It just happened to do it in 3 days. So it's not like this market wasn't forecasted or measured ahead of time. And if you've been following the stream for the last month or so, once we had this push down to like 550, I said this area is vulnerable. If we break below this level, there's nothing stopping it. Don't think about this level or this level. Nothing stopping this until that previous all-time high. And where do we come to? Previous all-time high. Like, even though this was a crazy, scary sell-off and we hit that 20%, peak to trough, it still was findable, right? And here we are, off those lows. Like, that's a pretty solid reaction to that, right? So anyway, I just, let's keep this like really simple, because the bigger fib level that I'm watching, we also pulled back to right around the 50% zone. So you take this previous swing here from the lows in October 2022 after that bear market low, and I'm still like, I still kind of agree this. I think there's going to be some trouble ahead here now that we have flirted with this previous high. But the nice thing is as long as this isn't like a deep recession systemic risk that brings us into open space this way, that would be like way more concerning. Okay. If the market can maintain protection around that level, this could be kind of our chop fest in here. And I think that's okay. I think we can survive in there. Just don't do anything crazy. But if this is a wave 1, 2, 3, we had our pullback for wave 4. I still wonder if it's possible that this whole thing with tariffs settle in, show some U.S. economy resiliency, as long as U.S. job numbers don't start to trend aggressively higher by September, October, November, December. And the reason that's the window I'm watching so closely on jobs is because all of the federal government layoffs are not really going to hit the tape until September or after. And if those workers don't find jobs in the private sector, that's going to start popping up in our jobless claims, initial jobless claims, continued jobless claims, and that unemployment rate goes from a 4.1 to what the Fed is forecasted by the end of the year around 4.5%. That's a big jump. I don't think there would be any type of intervention by the Fed until maybe this spikes up into the high 4s, maybe even 5%. I don't think there's any intervention from the Fed unless we are down to maybe 4,000 and having like maybe a 30% dip from the all-time highs. So this idea of like the Fed put or the Trump put, I mean, I don't think there is a Trump put as far as if all the administration is thinking about is trying to play hardball with this tariff stuff. I don't think there's a Trump put. I mean, clearly his approval ratings have dipped hard. Narrative isn't changing. Fine, but the Fed put is still lower. The price to earnings S&P, we're at 19 right now. Usually when the market finds a true bottom, we're trading around like a 17 or 16. Unfortunately, that's a little bit lower. That's like a 4,500 S&P. That's a 4,250 S&P. And I don't know how that settles in, but we're going to find out. Okay. All right. So anyway, fib wise, we hit a 50% pullback zone, previous all-time highs in the 2021-2022 peak. That's exactly where the market pulled back to. And you can see that measured move from the high-low breakout point, like a big bear flag. And now the market's up. And, from the lows from yesterday, it's like, that's a big swing, by the way. In 2 days, you saw a bottom to move. I mean, that's an 8.7% swing in 2 days. So am I super stoked and excited about the market showing, 3.79%? It's certainly better than being red. But I think this is a relief rally, and the bears are still going to have their chance to claw back a little bit. Where would I be watching? It's here. Anywhere at this gap fill or anywhere at this past support becoming resistance, or even the 200 moving average. Any relief rally that gets us up into this area, I'm going to look for some shorts or some shorts or some shorts. Those obviously aren't perfect. But trading options, I can probably give myself like a 30, 60, 90-day window to have some of those shorts reposition with much lower volatility, so that the puts will be a little bit cheaper, which is good, because even down here, buying an out-of-the-money put was pretty expensive. And granted, the market was gapping lower, and those paid pretty well. But I was still paying somewhere into, $4, $5, $6 for a long put. That was out of the money, by the way.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.